What's up, traders? In this video, we're going to be discussing trading psychology. So stay tuned. Now we're going to be performing a case study here on NAS 100 and looking at price action from this past week. And we're going to be discussing, number one, the importance of sticking to your plan, how easy it can be to stray from your plan and FOMO into a trade. And then we're going to be looking at some of the negative repercussions that can bring about. Now we're going to be looking at the 50-minute time frame here on NASDAQ, and we're going to be focusing in on price action in this area here on Monday, the 22nd of April, 2024, just before the open of the London session. Now, I really enjoy performing case studies. I have quite a number of case study videos up on my Patreon available to the CTFX Premium members, so definitely feel free to check those out. And the reason I enjoy performing case studies is because, number one, it's just another way in which you can put reps into the market in terms of practicing your approach, studying price action, and firing up that particular activation for seeing your setups and seeing the different entry types that you want to execute on. But then also, it's a really cool way of studying the characteristics of a certain market or the characteristics of price action. And what we're going to be focusing on here on the 15-minute time frame is a scenario that took place after price action pulled back into this well-priced, refined 15-minute supply zone. Now, as you can see, our 15-minute time frame is bearish. Our most recent breakout structure is this bearish break in here. We already have our 15-minute pullback taking place, which means that we were able to establish our new 15-minute range. Once we establish that 15-minute range, we are obviously anticipating a pullback into an area that is well priced, in this case, premium pricing. Before then, we see a resumption of that underlying trend to target the 50-minute week low. Now, let's just for a second outline what a typical trading plan would look like in a scenario like this. You would obviously identify a well-priced area. So we have this larger 1 hour supply that sits in here. And within that larger 1 hour supply, we have this 15-minute supply, which is effectively this bullish candle here, which has just been refined to the wick of that candle. And within that 15-minute supply, you can refine it even more on the 5-minute time frame by identifying this supply. And if we look at that 5-minute supply very quickly, you'll notice that, again, it is a 5-minute POI that does meet our rules, which then allows us to refine that 50-minute supply just a little bit more. And crucially as well, one thing that I really like is the fact that we had this liquidity sweep prior to that POI forming. And then at the extreme of our range, we've got this refined 1 hour supply zone that sits within a much larger 4 hour supply. And if we hop out to the 1 hour very quickly, again, just to show you that we do have a valid 1 hour supply zone denoted by this single candle in here with our liquidity and our imbalance that sits just below it. So once we have that range established, in terms of our trading plan, we obviously want to go ahead and identify areas where that pullback can come into and where that continuation can take place from. And we have now identified 2 areas where that continuation can originate from, with this 50-minute supply being the first well-priced POI where that continuation can take place. Now, because we're dealing with NAS 100, what I've come to realize is that this market tends to prefer shallower pullback periods before the continuation takes place. It very rarely targets the extreme before that continuation takes place. And when it does reach the extreme of a range, it often leads to a complete structure shift, i.e. a violation of your strong swing point. So with that equipped and with that in mind, we can now place just a little bit more importance to this area in here because of the tendency of this market to not always pull back to the extreme. Now, as per our trading plan, after we have identified those areas where the continuation can originate from, our next part would then be how we get involved in an actual trading opportunity. One of the easiest and simplest ways to do that is to simply place a limit order either at the open or the midpoint of the POI which you identified, and then looking to give your stop loss a bit of breathing room in terms of your placement here in case you see a sweep of the POI you're looking to trade from. And then using that entry type, we would expect a position like this. The second entry type that we can use in a scenario like this is, instead of placing a limit order directly at the POI, we would wait for our internal structure to shift bearish first in order to signal the start of our continuation phase. And upon our internal shifting bearish, we would then look for the POI that generated that break of structure to the downside. And then we would look to trade from that specific POI. So what this would do is, this would then allow us to wait for a bit more confirmation, wait for that change of character, as opposed to blindly putting faith that we would see a reaction from here. We now have a very clearly defined approach for how we look to execute. And then on top of all of that, the 15-minute time frame is our entry time frame. So the time frame where we look to execute trades. So what we've now done is we've outlined a trading plan that we can use to execute in this area. The reason we have a trading plan is because it, number one, is an approach that has shown to be consistently profitable over time. And number two, it is something that we can then use to execute consistently over a period of time in order to allow that positive expectancy of the approach to actually play out. That's why a trading plan is so important. It just adds structure to what we're doing in the markets. Now, with this specific scenario, and the reason I've pointed this area out is because, as you can see, the time at which price action trades into our refined 15-minute supply in here is during the Asian session, right? This is approaching the close of the Asian session. So we haven't seen the open of our London session yet. So let's just say, for argument's sake, that you're someone that trades the London session and the New York session. With price action coming into this POI during the Asian session, it means that you would not have had the opportunity to place your limit order directly on this POI. Because if you look a bit to the left in here, you can see that our internal structure only shifts bullish in here to signal the start of our 15-minute pullback phase as we go into the Asian session of Monday, the 22nd of April, 2022. This means that at the end of the previous week, which would have been Friday, the 19th of April, 2024, price action would have still been hovering in and around here, and we would have effectively still been trading within this impulsive phase. So unless you placed a limit order on Friday the 19th of April, you would not have had the opportunity to place a limit order coming to your charts on Monday the 2nd. And that would have now eliminated the option to use that first entry type where you just place your limit order directly. But that's not a problem, because you still have the option to wait for that confirmation to signal the start of your continuation phase and then looking to execute from there. Now, what a lot of traders tend to do, and this is where things can get very sketchy, and this is where things can often lead you down a very, very painful path. Once traders get to their charts and once they've seen price action interacting with the POI that they wanted to trade from, they often feel as though they are going to miss out on a really big move, especially after seeing a large engulfing candle like this on your trading time frame, because this bearish candle is indicating a lot of bearish momentum has stepped into the market after prices interact with your POI. Now, what would FOMOing into a trade in this area look like? Well, the first thing is a trader might go ahead and execute at markets where price action is at whatever point in time they get to their charts. They would then place their stop loss just above this internal high in here, because we've already seen the mitigation, and then they'd obviously be having their TP target, which would be this 15-minute week low. That would be one of the first ways in which they would FOMO into a trade. The second way in which they would FOMO into a trade is by dropping down to a lower time frame to see whether or not their entry model is satisfied. And the reason this can be very destructive is because unless this is something that is in your trading plan, unless this is one of the ways in which you can get involved in an opportunity, having missed out on the initial mitigation, you will essentially be straying away from your trading plan. So what that would look like is dropping down to something like the 3-minute time frame and then identifying this change of character. Now, very quickly, I just want to elaborate that the change of character we see taking place is effectively the change of character that is helping facilitate this internal pullback after this break of structure has occurred. This is not a change of character that is helping signal the start of our continuation phase, because in terms of how we have mapped market structure out here on the 50-minute time frame, at this point in time, this violation here would be the change of character that signals the start of our 50-minute continuation. So on the 3-minute time frame, having now identified this change of character here, you would then go ahead and identify this 3-minute supply zone with your liquidity pool sitting just below that POI. You would then be looking to place your stop loss just above this high, because this is where your change of character occurred from. And then you'd be looking to target, obviously initially, maybe your Asian low down here, but then overall, you would be aiming for your 15-minute week low. And this would obviously allow you to have a really nice tight stop with a very big risk to reward ratio. Now, I want to stress that here on the 3-minute time frame, right? This setup, if you trade the 3-minute time frame, if you are someone that waits for the mitigation of 15-minute supply and then dropping down to a lower time frame to look for an entry, this would be part of your trading plan, and taking this opportunity would not be wrong at all. But if you're someone that executes on the 15-minute time frame, dropping down to the 3-minute or something lower to look for an entry just because you missed out on your initial entry, would be breaking your trading plan, and it would be classed as chasing a trade and FOMOing into a trade. And the reason I make this distinction is because the person that normally executes on a lower time frame, they know that in general, they are executing more trades during a trading day and during a trading week. Whereas someone that's executing on the 15-minute, the 1 hour, or the 4 hour, they aren't executing as many opportunities purely because of the fact that there just isn't as much price action printing on their time frame. And the reason this is important is because from a psychological point of view, there is an adjustment that needs to be made. Knowing that you're executing more trades means that you need to be comfortable with taking more losses overall, right? And if you're only executing on the 15-minute time frame, you might not be ready from a psychological point of view for the outcome of this trade. Even though it looks perfect here on the 3-minute time frame, you might not be ready for the outcome that this opportunity presents, because inherently, as good as it looks, this opportunity is very risky because of the fact that the change of character you are looking to trade from is only a change of character that is facilitating this particular internal pullback. And by default, trading on lower time frames is going to carry a lot more risk because there's just so much more price action, there's so much more noise, and there's just so much more liquidity that's being pulled into the market. And if we allow price action to play forward, you can see that we do come back up into this 3-minute supply. As we come into that POI, we get an initial bearish reaction from that POI, but then price action continues to trade higher. It sweeps this high again, and depending on where you placed your stop loss, you would have now been tagged out of this trade. Now, the key thing here from a 15-minute point of view is that at this point in time, after this 3-minute supply fails, your internal structure from a 15-minute point of view has not shifted bearish just yet. You haven't seen confirmation that your continuation phase has begun. So if you're someone that executes on the 15-minute time frame and you've now taken a loss trading from this 3-minute zone, you, from a psychological point of view, you might be all over the place. You might be kicking yourself because you've now broken your rules and you've taken a loss which for the most part could have been an avoidable one. Also, you might now be in a state of wanting to make that money back. And now the initial FOMO that led you to take this trade has now evolved into a state of revenge and wanting to take money back from the market, right? Because you're angry now. The market has taken money from you. You don't like it. So now you want to get back in there and you want to look for an opportunity. And so what you do is you go back down to that 3-minute time frame, and as you see price action playing out, you then go off and you tell yourself that, okay, cool, I can see that there's a chalk in here. I can see that I have another 3-minute POI that sits just up in here, for example, right? After the chalk that you've identified, you go off and you identify liquidity that sits just below your POI. And then what you now do, because you've taken a loss, you go off and you put on another trade at this 3-minute supply, now looking to win some of that money back. And then what happens? You place your sell limit order on 3-minute supply. You are now waiting for price action to come into that POI to tag you in. We can see that we get tapped in during this candle in here, which is just before the open of the New York session. Again, we get an initial bearish reaction out of that POI, but then as price action continues trading, price action spikes up once again and takes you out. So now you've taken 2 losses on the bounce, trading on a time frame that isn't a part of your trading plan, that isn't a part of your trading approach, right? And so now, and this is Monday, remember, this is Monday, the 22nd of April. This is the start of your trading week. Now, having taken these 2 losses, not only have you opened your week with a negative P&L, but from a psychological point of view, you're also down. You've now lost confidence in your ability to trade, your ability to identify a POI to trade from, and you may have even lost confidence in the actual approach that you're trading. And this is why we said at the start, the trader that typically executes on the 3-minute time frame or lower time frames in general, they are used to executing more trades just in general. And they are used to taking more losses in a row, right? They know that that's part of the game of trading these lower time frames. But if you're someone that executes on the 15, this might be a culture shock for you. This might be something that you're not used to. And from a 15-minute point of view, you can see that we still, right, haven't switched from this bullish internal market state. Price action is just hovering in this area. It's effectively consolidating around your 50-minute supply, and it has effectively just generated these 2 liquidity sweeps. And like we said, your lower time frames, a lot more noise, a lot more liquidity being drawn in. So now, having taken this second loss, you might be so completely destroyed because we're now entered the New York session. You now might be so completely destroyed that you either hop on YouTube and look for a new trading approach. You might just close your charts completely and say that this is not for you. You walk away from it, right? And you just end up in general feeling very down and very off color, as it were. Now, as we play price forward, and I want to show you how price action actually played out here. As we play price forward, we can see that soon after this secondary sweep here, we do in fact get price action breaking to the downside in here. You could actually go ahead and identify your internal shift up here, because if you think about it, we have our break up, we have our pullback, price action then hovers around, but it doesn't really create a new high, and then it rolls over. So you could apply an FTC in here. But once we see that internal shift, we now have our internal structure shifting bearish, signaling the start of our 15-minute continuation. We would then, from a 15-minute point of view, we would then be looking for that second entry type that we spoke about, looking to identify the POI where that switch in internal structure originated from, and then we would be looking to execute from that POI. So on the 15-minute time frame, it would look something like this, with your overall target being your 15-minute week low. Now, at this point in time, right, you then need to make a decision as to the opportunity itself. From a trading point of view, you have your rules being met, but now you need to see whether or not the juice is worth the squeeze in this scenario, because the amount of real estate that we've got to our overall target and where we're looking to get involved because we needed to wait for that confirmation, that means that our overall risk to reward ratio might only be a 1 to 3. It might even be a little bit less depending on where you place your limit order. So now you need to make the decision as a trader. Do I want to get involved in this or not? Remember as well, even though overall we've come to realize that NASDAQ tends to favor these shallower pullbacks before the continuation, we definitely still have this 4-hour supply all the way up here, and there still is that potential that we could see a deeper pullback. So do you go off and trade from here, or do you just not take this opportunity because it's just not worth your time at this point in time? If we play price forward, we can see that price does indeed end up coming back in to mitigate your 15-minute supply, but it only generates a very short-term reaction in here before then reversing and continuing with this new bullishness, violating to the upside, right? And now trading in towards that 4-hour supply zone. Now, I want to point out that even though you've also taken a loss here on the 15-minute time frame, what has happened here is you've taken a singular loss as opposed to the 2 losses experienced here on the 3-minute time frame. And not only is the number of losses you've taken less, but also from a psychological point of view, this loss won't be as damaging as these 2 losses in here because you followed your trading plan, right? You waited for the pullback into a well-priced zone. Because of the fact that you missed out on the opportunity to get involved with your 1 entry type, you have identified the 2nd entry type in here and you've executed according to your trading plan. So even if you take a loss, this is not going to, or it should not, completely destroy you, because you know that there was always this possibility of a deeper pullback into the extreme. Even though the market doesn't always do that, the possibility is still there. And that is something that will allow you to just, from a psychological point of view, manage this situation a lot better. And then going into the rest of the week, the Tuesday, the Wednesday, the Thursday, the rest of the month, you are still in a very firm, confident place, because you know that at the end of the day, every single trading opportunity has an unknown result and an unknown outcome. And all we can do is try our best to stack the odds in our favor. So a case study here on NAS 100 from Monday, the 22nd of April. Again, these are the types of case study videos that I frequently make over on my Patreon offered to the CTFX Premium members. But I wanted to do one here because a lot of viewers of the channel have been asking me to make a video on trading psychology, and I just wanted to wait for really the perfect scenario, the perfect type of price action to draw in as many psychological points as I possibly could. And I really do hope that this video has done that. So definitely feel free to revisit this price action for yourself. As always, I appreciate you guys so much for watching, and I'll see you in the next one.